So as I mentioned before, the United States, we're expecting 2.4% growth, a little bit faster than we've had over the previous few years, with a slowdown towards the fourth quarter of the year. California and Orange County in particular, we're expected to grow somewhat less. What we're now predicting, and these predictions come from the Anderson Center for Economic Research here at Chapman, is for the year, the GDP is going to be down about 5.3%, which is basically $1 trillion lost out of the economy. California and Orange County a little bit less, even worse. California lost 2.9 million jobs at the peak of this. We expect that by the end of the year, will be down 800,000 jobs. So most of those jobs will come back. 100,000 of those lost jobs out of the 800,000 will be from Orange County. I want to show you the next slide, and this one is probably a little more useful, the predictions for the quarter. So this is obviously an unprecedented situation. When we had the recession in 2009, 2008, 2009, that was like a 7-quarter event before the recovery started. This recession is going to be 2 quarters, and it's basically over already. So in the first quarter, the slowdown in March meant that we lost about 4.8%. This is growth in real GDP in the United States. Second quarter was the ugly one. The GDP dropped 32.9%, almost a third. The third quarter, they don't have the numbers out yet, of course, because the third quarter is not over. But we're expecting to be about 19.2% growth. So a lot of it's bouncing back with 14% growth in the fourth quarter. And this is kind of in line with what some other projections were. I just saw the consensus of various other economists. They have the third quarter coming in at about plus 20%. So a lot of the hit in the second quarter is going to bounce back. So in the parlance of what people have been talking about, this would be a V-shaped recovery. And the question is, how did this, bounce back so quickly? It's no mystery when you don't let people go to work that the economy is going to tank. But how did it bounce back so quickly? Well, the fiscal and monetary stimulus was really unprecedented. We increased government spending $2 trillion in 2 months. Keep in mind the entire budget is a little over $4 trillion normally. So we increased it $2 trillion in just 2 months. The Fed was able to, by essentially buying all that new debt, drove the federal funds rate down to 0.1% in 2 months, so almost to zero. Following the 2008-2009, it was about 2 years before the Fed had pushed interest rates through their actions, influenced interest rates until they were down to close to zero. So the Fed moved much faster. The federal government moved much faster this time than 2008-2009, and as a result, we're expecting things to bounce back pretty quickly. So employment growth is what those numbers are for California and Orange County. We don't have the estimates for the Inland Empire yet. The Inland Empire wasn't hit as hard by this as Orange County was. And one of the reasons for that is that tourism isn't as big a part of the economy, which may be a surprise to you, that you don't get as many tourists as Orange County does with Disneyland and that sort of thing. And the distribution business continued to do well during this downturn. And it's a bigger part of your economy. So the Inland Empire, which usually is a little more volatile than Orange County and California as a whole, probably is coming out somewhat better than the rest of the state on this. But as you can see, the lingering employment losses are going to be here throughout the year in California. So it's really this kind of unprecedented speed at which the federal government reacted in terms of spending and fiscal stimulus that really turned this into a 2-quarter event rather than something that could have spiraled out of control. Now, one of the things you're probably wondering about is, okay, the federal government passes this fiscal stimulus, the federal budget. I think I have a slide on this here. As you can see, the interest rates have dropped fairly dramatically. They were low in the first place, but mortgages are going to be down to 3% or so. T-bond dropped almost in half, prime rate, et cetera. 90-day T-bill is almost zero. So they took pretty aggressive action. And you may be thinking, and I know I'm thinking, how can the federal government, I have the numbers a little later, increase the deficit to $3 trillion, to over $3 trillion, increase spending for the year? It's going to come in at probably $6.6 trillion. How can they do that much deficit spending? And who's buying the debt? The debt is being bought by the Fed. So essentially, when you talk about printing money, this would be an example of it. And so the question is, is this sustainable, and how do you unwind all of this? So generally speaking, this would be a serious problem, but there's a few caveats here. So essentially what we did is the equivalent of if your income dropped and you took out a second on your house to pay your current cash flow needs, financed through, borrowing on your house or something. Now, how good an idea that is depends on how fast you're going to get back to work and your income's going to get back to normal, and how much you had to pay in interest on the second. Well, in this case, they're paying almost nothing in terms of interest on this borrowing. So borrowing $1 trillion, $2 trillion, $3 trillion at almost zero interest is not as alarming as borrowing at, say, 5% interest. So that's one issue. And in fact, the economy, if you're having the V-shaped recovery, the bounce back is pretty quick. So this is more akin to getting a very low interest loan to cover a 6-month shortage in your own cash flow, and then finance it over the coming years. So I'm not a fan, as you know from previous meetings, of government spending, and but when the government forces you to forbids you from working, they got to do something in the meantime. So they seem to have managed this a little bit better than they typically do. The other thing to keep in mind with some of these forecasts here, there's some assumptions in all of this. And the big assumption is, what is the government going to do? Since the economic problem was created by the government response to the virus, rather than so much the virus itself, that would have had some economic implications anyway. But the kind of unprecedented decision for most of the country and large industries to be locked down, to essentially close down the hospitality industry, retail, et cetera. That's what created the economic problem. It may have had a public health benefit, but it did create the economic problem. So how quickly they unravel this lockdown will determine how quickly the economy recovers. You've probably noticed, and I've even marveled at it, is whenever a county changes the rules, it's a matter of hours before businesses have responded. So they respond very quickly to changes in the rules and regulations. And so certainly Orange County is starting to loosen up a little bit. Here at Chapman, we'll probably have face-to-face classes in a couple weeks, I would imagine. And they're letting people in restaurants and that sort of thing. So you still can't get those tattoos you've been yearning for, but soon you'll be able to. So it's really, though, if governors drag their feet on opening things up, which they might for political reasons, depending on the circumstances, then then these numbers might be a little optimistic. The couple others. Here's some of the numbers for Orange County. So that first column is what we were predicting for 2020 at the beginning of the year. The second column is our updated prediction. The third column is the fourth quarter results, and this is year over year. So this would mean this fourth quarter versus the fourth quarter of 2019. And the last is the fourth quarter versus the third quarter. So this is probably the last column is a little more relevant than usual. Normally, when you see the quarterly results, they're that third column because of the seasonality in certain things. But given we're trying to figure out how fast the economy is going to bounce back, that fourth column gives you the idea. So we're expecting, by the end of the year to be pretty much where we thought we would be. Because as you can see, the fourth quarter is really going to be a big pickup from previous years. So here's some statistics: personal income, payroll, that's transportation and warehousing payroll in particular. Taxable sales. For some reason, I have taxable sales for food and drink. I don't know who was interested in that or why, but there it is. Housing prices. Housing prices are a little tough to figure out in the long run because you couldn't sell any houses basically in the second quarter. And now the market's really kind of exploded and the inventory hasn't caught up to the demand. So there's been a bit of a spike in prices, but we really expect in 2021, when things settle, for housing prices to go up moderately, not extensively. This is the same data for Orange County. You can see it's similar to California. And again, we don't have this for the Inland Empire yet, but those numbers are going to be a little stronger than what you see here. So the one of the reasons that it hasn't been worse for California is where the job losses have occurred. So as I mentioned before, about 2.9 million of the losses originally in California, that's jobs lost. Half of those were in two industries: retail, where a little over 20% of everybody in retail was laid off, and hospitality, so hotels and theme parks, stuff like that, where half the employees were laid off. Those are relatively low-paying jobs. So those pay about $30,000 on average versus about $68,000 for the average industry sector. So the low-paying jobs with the fiscal stimulus that kind of made some people even ahead, as a result, mitigated a lot of the damage. We share a little more information with you. So what about the budget? So as I mentioned before, this is the spending. We were expecting to spend $4.8 trillion this year. Now it's expected to come out at 6.6 trillion for the year. So that's a 37% increase. This is a 37% increase on top of increases that are, of course, faster than the economy is growing: 7.5%, 5.5%, 5%. Those are all rapid increases in spending. Taxes are going to be coming a little bit lower this year, obviously, because people laid off, not making as much money. But so I think that percent increase is wrong. I forgot to update this number here. But that means the deficit is going to be about $3.3 trillion this year, which is really unprecedented. We used to think of $1 trillion as a huge deficit, but that was back when $1 trillion was real money. So the 2020 is going to be a huge deficit. So again, now that you have 25 trillion or so in total government debt, how are you going to get out? The answer to that is probably inflation. So if you think about it, the Fed currently targets about a 2% inflation rate. Well, if you owe $25 trillion, 2% inflation means you reduce the amount you owed in real dollars by 500 billion in 1 year. If inflation is more like 3 or 4%, then in real terms, you're dropping $1 trillion off the amount owed. So my guess is through some combination of means testing and increases in taxes on entitlements, Social Security in particular, and a little bit more aggressive inflation, they're hoping to eat away at that federal deficit and get it back to a reasonable number. Now I wanted to talk a little bit about where we are in terms of the election. And there is unprecedented uncertainty here. And there is so much uncertainty because there's basically been no campaign. Usually we're tortured through a year's worth of primaries and then all summer rallies and big events and that sort of thing. And the Democrats, when the COVID thing hit, essentially just canceled the primaries and appointed Joe Biden the nominee. And on the course, the Republican side didn't really have any competitive primaries anyway. And so there have been very few of the news-making events that you're used to seeing here. So the race is really just getting started at this point. And so the polls and other indicators are not going to be super reliable. If we're trying to predict well, let me just kind of lay out a few things. There's, of course, the presidential election, but then there's the House and the Senate. For the Republicans to take control of the House, they would need about 17 House seats. And for that to happen, this would mean that Trump would need to win by a moderate margin. So maybe a 52-48 win would be enough for the Republicans to pick up the House. If he loses it, they're not picking up the House. And if he wins in a squeaker, they probably aren't either. The Senate, you can be a little bit more, because there aren't 435 races, you can be a little more specific. So currently the Democrats need to pick up 3 seats to get the Senate. Although there are 33 people running, most of which are Republicans, there are basically 6 races that are at risk. 2 of them are Democrats and 4 are Republicans. And this was what we had mentioned, I think, in January, and it really hasn't changed yet. As I mentioned before, there's also, through a bit of a fluke, Alabama has a Democrat senator who's up for re-election. He won in a special election. That seat's gone for the Democrats. So really the Democrats are going to need 4 more seats. And there are 4 Republicans at risk. McSally in Arizona, Gardner, who is in Colorado, Susan Collins in Maine, and Tillis, who is in North Carolina. The other ones there were others that were sort of lean Republican, lean Democrat. Most of those seem to be in pretty good shape. There was some thought that Shaheen, who is a Democrat in New Hampshire, might have some problems, but she appears to have a double-digit lead. And Michigan is the other Democrat seat that's at risk. Some polls have the Republican ahead, but most don't. So that one we'll have to wait and see. Most of the state polls and Senate polls at this stage aren't really any good. So the Democrats are going to have to run the table to take the Senate. So it's doable. If Biden wins easily, then they have a very good chance, and maybe even are favored to do it. But if it's a close race, whether Biden wins or loses, it's unlikely the Democrats are going to take the Senate. So, which would be absolutely vital. Well, if you're a Republican and you don't want Joe Biden's policies implemented, that's going to be vital, because if they control the House, the presidency, and the Senate, and the Senate has said they're going to try to abolish the filibuster, then much of the agenda the Democrats will get through. So if the Senate stays in Republican hands, then it probably won't. So what are we looking at for the presidential election? Well, you've probably seen a number of polls that have Joe Biden up by a moderate amount, 5, 6, 7 points. Real Clear Politics tries to get an average of these polls. They have him up by like 5.8. And these, of course, are national polls. They're not state by state. So 5.8 would look like a fairly comfortable position to be in. That's similar to what Hillary was, or Secretary Clinton is. I don't want to mean to call her Hillary and act like we're close friends. We aren't. So so he's doing about the same, and of course you know how that went. One of the things to keep in mind with national polls is with the Electoral College, whether you win California by 1 vote or 5 million votes, like Clinton did, it's still the same number of electoral votes. And so a Democrat can win by a couple percent, as the Clinton did, and still lose the Electoral College because you run up a big run in California and New York. That increases the popular vote, but doesn't do that much for the electoral vote other than those being close. Other thing to keep in mind with these polls is there's one poll, there's 2 indicators that I'm paying the most attention to. And of the polls, the one I pay the most attention to is Rasmussen. And this one actually has Trump up by 1 in its latest poll. When you do a poll, you call, say, 2,000 people, and then 1,000 you count in your poll. And they all try to eliminate people who aren't likely to vote. So they ask you a few questions to screen you out if it doesn't sound like you're going to actually vote. And then they try to get it to be a representative population, because if you call, you're going to get older people, and women are more likely to answer the phone than men, and so these things could be skewed. So all of the polls will try to weight the results based on their turnout model, who they actually think are going to vote. So what percentage of men and women do they think are going to vote, various age groups, ethnicities, stuff like that. Rasmussen also looks at the party affiliation. And this is the key to every single poll, because 90% of the Democrats are going to vote for Biden and 90% of the Republicans are going to vote for Trump. So how many Republicans or Democrats you have in your poll essentially determines the results. None of the other polls screen for their estimate of the percentage of Republicans and Democrats likely to vote. So let me give you a quick example. The Economist just released a poll, shows Biden up by 9. So if you're a Biden supporter, you're all excited. But in that poll, 36% of the respondents said they were Democrats and 23% said they were Republicans. Well, in 2016, 35% of the people who voted were Democrats, but 31% were Republicans. So 4% more Democrats than Republicans voted in 2016. This poll has 13% more. Hence, they have Biden up by 9. So that kind of poll is going to be meaningless. What Rasmussen does is they survey 15,000 people each month and use whatever percentage, say they're Republicans or Democrats, and to weight their polls. So currently, their model assumes 37% of the people voting are Republicans and 33% are Democrats. So that's probably a little favorable to Democrats. So the thing to keep in mind when you look at those polls, if you're not looking at Rasmussen, then I would really only focus on what independents are going to do, because the poll is going to be skewed by Republicans and Democrats. And so, for example, in that Economist poll, they have independents favor Biden by 4 points. So you're probably the reality currently is anything from Trump up by 1 or so to Trump losing by 4 or so is probably the range. The other thing to pay attention to is the betting markets. So you can actually bet on who you think is going to win the presidency, and you bet, real money. And so economists think these are more reliable because you're not just offering your opinion, you're betting on it. So you're likely to be less sentimental and more objective. The betting markets right now have Biden with a 52% chance of winning the election and Trump with a 48% chance. So essentially the race is a toss-up at this stage. The question is, so what's going to happen? Well, because the race is just getting started, it's going to be driven a lot more by what happens the next 47 days, I think it is, than the previous 6 months where the dynamics of the race normally would have been set. So if you look what the new information could be, it's obviously the big one's the virus. Is it going to continue to wind down and the economy open up more and have more economic growth and obviously positive attitude? Or could there be some sort of second wave that hits in the end of October? If a vaccine is developed, well, obviously the vaccines are already developed, but if the vaccines are verified as safe sometime before the election, that would have obviously a huge bump for Trump. So what happens with the whole virus thing is still up in the air. A couple other things that might happen is, as you've noticed, there's a rollout of good news from the Middle East. A number of Arab countries have now engaged in treaties with Israel, which kind of would have been unheard of. And if that accelerates, that could obviously be very helpful for Trump. The continuing civil disturbances, obviously that's a huge bump for Trump. That's probably the primary reason this race has narrowed kind of the spectacle of Democrat mayors supporting rioters, or at least positioned that way, isn't going over very well. Even in states, they've essentially put Minnesota in play, a state that you wouldn't have thought had any chance at. And so if those disruptions accelerate or drift away, that'll have an impact. The economy obviously normally is a big driver of the election, but the Fed just said the other day they're going to keep interest rates near zero for as many as 3 years. So we really don't expect any economic disruption. So the V shape is still there. There's two other issues. There's going to be some October surprise. I'm sure Trump is going to be accused of sexual assault on October 29th, I predict. So as they always do at the last minute on these things, and I'm sure Hunter Biden is going to be accused of something by then as well. So one of those might stick. But the other issue is Joe Biden's health. Anybody who has seen him has realized his health has deteriorated pretty substantially since the primaries. A year ago, when he was in those debates, he looked older and lost a step, but seemed fine, at least to me. Now he does not seem fine, and it's we're having a debate. I guess next week is the first one. And there's supposedly going to be 3 of them. It's hard to imagine how he's going to come across very well in that context. And if you're a Democrat, it doesn't matter. You're voting for the Democrat agenda. It doesn't really make a difference whether he personally is on in charge or some committee of other people are handling it. But for independents, obviously, it will matter a lot. So how he comes across in those debates, it's entirely possible that he completely melts down. And you look for an opportunity to replace him on the ticket. It's still almost too late, but not quite to do that. So if you look at the factors that could affect the race going forward, news about the virus, a vaccine, the Middle East, the civil unrest, the economy, Biden's health, almost all of those are ones that favor Trump. Either they're no news, or if they're news, they're probably going to be positive for his campaign. Again, with whatever negative attacks they come up with for Trump may or may not resonate. So my take on this is, for what it's worth, and it isn't worth anything. At this point, there's so much uncertainty. Is before the virus, it was looking very good for Trump. We were predicting he'd win by about 5%, which would mean they'd hold the Senate and maybe even take the House. Right now, there's just too many events that can affect the outcome to have any certainty, but I think you would have to give the edge to Trump at this point. And while it's tempting to think it's going to be close, it's very possible this could be like the Reagan-Carter election, where it's perceived to be close and doesn't turn out to be close because at the last minute, events shifted people to Reagan. So, so my sense is the Republicans will hold on to the Senate, maybe lose a couple seats. They will not get the House, and Trump will probably win. Right now, there's about 216 electoral votes that are strongly favored for Biden and about 200 for Trump, with the usual suspects, the Midwest, Michigan, Ohio, Pennsylvania, and Florida being the big ones that'll end up deciding it. So with that, I think that's all I've got. So if you've got any questions, I would be happy to answer them.
Thank you, Dr. Turk. This was great information. If you do have a question, just type it in the chat box and I will try to monitor those. We don't have any yet, but maybe one of our board members might have a few questions for Dr. Turk. We have first one that came up. Thank you for the insightful information today on the economy. Question pertains to AB 5, the gig economy bill. Due to the volatility, demand is seen as by the statistics coming out of the Port of LA that saw a 12% increase in imports in August compared to July. Owner-operators and independent contractors are a necessary and viable demographic that the industry uses. Question is, if the injunction is lifted and the bill is imposed on this sector, what impact do you see this having on companies, supply chain, and the overall economy?
This one would be very bad news if it's comes into effect. I mean, for universities, this is a mess too, because we have a lot of our classes are taught by full-time faculty, and a certain percentage are taught by adjuncts that teach 1 or 2 classes a year. So they're affected by this too. But the great thing about the gig economy, as it's called, is its ability to be innovative, to respond to new market opportunities, to allow you to take advantage of entrepreneurial initiatives, and it really is going to kill that, and it's going to have a very negative impact on the entrepreneurial initiative. And not only does that have a negative impact on the economy, it has a negative impact on people. It's taken away opportunities that they'd want to pursue, whether it's to try to get a second income, or if you're in semi-retirement, to get a partial income, or maybe come up with some new business venture. So I really think this is a regulation that is really harmful for individuals and for the economy as well. So I haven't seen the polling data on that yet to know what general attitudes are, but there is I did check the proposition on this that would be relevant to you on the split rolls, which is revisiting Proposition 13 and keeping Proposition 13 intact for residential property, but raising property taxes on business and commercial property. That one actually looks like it's going to pass, or at least is ahead at this point, and that would be very expensive for you. That would mean any property you've had for a while that's got relatively low property taxes and warehouses and that sort of thing. If this passes, those are going to go up, pretty dramatically.
Okay, thank you. We have another question. How do you think all of the mortgage forbearance will impact the housing market when those loans become due or foreclosures start?
Yeah, I think it's the residential is not so much the worry. And the reason for that is housing prices have gone up. And so even if you don't have the cash flow to pay your mortgage, you do have positive equity probably in the house. So it's not like 2008 where the crash in housing prices meant people walked away from their houses, their mortgages, even if they could afford to pay the mortgage, because you're upside down in the house. So, but on the commercial sector, if you had a hotel that's been empty for a few months, they're starting to fill up now. Those and other commercial ventures, retailing, all of those types of properties. So those loans are being refinanced, deals are being worked out. And for sectors where it's a temporary cash flow problem because of the virus, I don't think it's going to be a problem. For those that are where there's a long-term trend and this has just exacerbated it, then that's going to be an issue. But we're not really projecting any collapse in real estate prices, either commercial or residential. But there's no question that not being able to evict somebody is going to be a problem. So some of the data I've seen is businesses are still collecting 85% or so of their rents, and you never collect 100%. So it's only off slightly at this point. If this drags on for another 6 months, of course, the problem will start to get serious.
All right, another question here. What is the quick snapshot on economic scenario to expect under a Biden election?
So it's always got to be, if you assume some percentage of what they are claiming they want to do, they actually do, then it would be very bad news for the economy. There's no question about that. Some of the things he's talked about that are probably serious, especially if they get control of the House and Senate, is on the tax issues. He wants to raise the top tax rate back to 39.6, which if you're in California, the top tax bracket is what, 13.6 or so, and they want to raise that as well. So you're back over 50%. And you might think, well, yeah, in the 70s, the top tax rate was 70%. What's the big deal? Well, at that time, there are all kinds of deductions. So, every time we do these tax reforms, you lose some deductions in return for a lower rate, and then the lower rate pops back up. So the top tax rate used to be 28% in the 80s. And so even with the Trump reductions, it's still relatively high. So that's going to be a problem. Capital gains, they're going to raise pretty significantly. And again, you look at that and say, well, that's only for people whose income is over $1 million. Well, if you have a capital gain that year that's fairly significant on top of what your income is, $1 million doesn't necessarily mean you're Bill Gates. So, to be affected by this. This means the small businesses that are selling a business they built over their lives, or farmers that try to sell their property, are the ones that are going to get hit by this, and that's of course the target. So his tax policies are going to be very create a more hostile business environment. The other thing that will be a problem is the regulatory environment. One thing that that I think has had a big impact on economic growth, and it's the primary reason that the economy has grown faster under Trump than it did relative to Obama and frankly Bush 43 as well, is he's rolled back a lot of regulations and that have made it easier to do business. And so that ends now, and you can be saddled with more regulations. And as you can see now, when the government's involved in telling you how to run your business during this COVID crisis, you get regulations that don't make sense for your particular circumstance. You don't get decisions made in a timely manner. Again, for us, we couldn't get an answer all summer out of the state of California as to whether or not we can have face-to-face classes, whether or not we can have people in the dorms. It doesn't do us that much good to find out 2 days before class starts that yes, or you can have people in the dorms. Arrangements have already been made, and so for your businesses, it's even more so a problem. So I think the consensus is that it'll be worse for the economy.
Okay, a stock market question. What will happen to the stock market the day after the election if Biden wins?
Probably nothing. And the reason it won't I say nothing is whatever impact a Biden victory would have on the stock market will probably be affected, before the election. If it's looking like he's going to win, then the stock market will adjust, before they get the final results. But the larger question is a Biden administration going to be bad for the stock market? And you might be looking at the stock market right now and say, wait a minute here, there seems to be a disconnect. Obviously the economy tanked, but the stock market's at record highs. So what's the deal? Well, keep in mind, the stock price is based on the long-term value the future cash flows that stock, that business is going to generate. It's not really driven by what your profits are going to be this year, unless that's a predictor of what they're going to be over the next 20 years. So if a company is selling for 20 times earnings, which is probably about the average for the stock market right now, that means only 5% of the stock price is money that your profits you're expected to make this year. The other 95% is profits you're expecting to make in the future. So one of the reasons the stock market has continued to do well is they're betting that the disruption caused by COVID will have no long-term negative consequences for the economy. The second thing to keep in mind is if you give a major corporation a major subsidy, that company's stock price is going to go up, even though it's going to harm the economy. So public policies that shift money to publicly traded companies that work for the disadvantage of smaller private companies is going to hurt the economy, but not necessarily hurt the stock price. Bailing out banks make bank stocks go up, even though it comes at the expense of the larger economy. So there's not a real pattern between the short-term stock market's reactions and who wins the election. There's going to be some winners and some losers under a Biden administration. And the people that anticipate losing, their stock prices will drop, and the winners, their stock prices will go up. So I wouldn't, even if you really, really think Biden will be bad for the economy, I wouldn't necessarily cash out your 401k and move it to cash over that.
Okay, we have another question about what do you think the overall impact on small businesses due to COVID-19?
Well, as with anything, it's been uneven. So, for example, in commercial real estate, the distribution industry, yours is the one that's still hot and has been, as people are scrambling to get more and more space. But for small businesses, there are some sectors that have benefited, and obviously some that are falling apart. But that's one of the big worries about this, and that's that I think is when you lock down the economy, if you some of the businesses that don't have the cash flow to survive are not coming back, and so those are losses that are forever gone. So I'm sure you've seen restaurants and retail stores that have gone out of business that are problematic, and those aren't coming back. Those losses are permanent, and so I think small businesses have generally been disproportionately hit by this. So it's a tragedy, frankly.
Okay. We have time for one more question since we're on close to 3 o'clock. Asking about the mass exodus of people leaving California, many of whom have California pensions, the teachers, the firemen, the police. Yeah. What is your long-term outlook on California's economy compared to the average U.S. state?
Yeah, that's a serious concern, and it's a serious concern because from just a fiscal standpoint, the way California is much more dependent on income tax than, say, sales or property tax in a lot of other states. So if high-income people leave, if businesses leave, they really get hit hard. It doesn't take that many people deciding they're moving to Idaho to really affect the state government revenues and exacerbate the pension crisis. Obviously, those pensions you're talking about are largely unfunded liabilities. So this will make that problem a lot worse. And if you look at the macro trends, it's very clear people are leaving high tax, high regulation states like California, Illinois, New York, and are moving to states that are less taxed, lower taxes and that sort of thing. So Texas, Florida, Nevada, et cetera. So that pattern in general is undeniable. And there's a temptation, especially if you're my age, everybody is looking wistfully at those people in outside of Boise and moving off to Nashville and places like that. There is a pattern that when housing prices are high, the people move out of California, sell the house, the equity you have, you can buy something way nicer and pay cash, and be better off. And when the economy is down, the economic opportunities in California, tend to draw people in. So some of it is a cyclical thing. If you look at those surveys by, how many U-Hauls are moving out versus coming in, a lot of that tends to be people cashing out of real estate rather than disgusted by, taxes and regulation. But the reality is people are moving out. And as you get older, you do actually get more mobile because you're not as tied to careers. And so I'm sure everybody on this Zoom call can think of somebody who's moved to South Carolina or Idaho or South Dakota, lately. So yeah, that exodus is real. Some of it is not California specific, but high tax states specific, and it'll have a real impact on the tax revenues for those states. New York, it already has created a problem. In California, if they raise the top tax rates, there's some discussion of a wealth tax. If there is in fact a wealth tax, then this will be accelerated very quickly.
Okay, well, really appreciate all of the information you've shared with us, Dr. Turk.